Hello everyone, welcome to my channel. Today we will be studying an introduction to accounting principles. As we know, accounting statement discloses not only the profitability but also the solvency of a business to various parties which are linked to the business, such as the proprietor, investor, creditor, or the government. It is therefore necessary that these accounting statements are prepared in accordance to some kind of accounting principles or rules. These are generally known as Generally Accepted Accounting Principles or GAAP. GAAP is defined as a set of standardized accounting principles used to prepare and present financial statements. It is important from the point of view of the stakeholders because it ensures consistency, comparability, transparency in the financial reporting of the reports prepared for the stakeholders. Its role in financial accounting proves to be very pivotal as GAAP guides the recording of transactions, ensuring accuracy and compliance with the accounting standards. If we look at an example of a company who follows GAAP in its accounting standards, we can give the example of Coca-Cola or Apple or any such company. They do so in order to maintain uniformity in their financial reporting. Coming to the kinds of accounting principles, first we have business entity concept. The business is treated as a separate entity or distinct from its owner. According to this assumption, the business is treated as a separate entity which is different, which is separate from the owner and all economic proprietors. A business unit should have a separate book and have recorded business transactions from the point of view of the business and not from the point of view of the proprietor, because they are two separate entities. Therefore, the proprietor is then treated as a creditor of the business to the extent of the capital that is invested by him or her in the business. Next comes money measurement concept. According to this concept, only those transactions or events are recorded in accounting which are capable of being expressed in terms of money. Next is going concern assumption. Here the financial statements are prepared with an assumption that the enterprise is a going concern and will continue the operations in the foreseeable future. Next, accounting period assumption. Here the economic life of the enterprise is split into period intervals known as accounting periods. As the going concern assumption, an indefinite life of the entity is assumed. Therefore, the economic life is also divided into artificially split periodic intervals, also known as accounting periods. Next is the historical cost concept. Here, the value of the asset is to be determined on the basis of the historical cost, which is the cost of acquisition. That is the cost which is paid for the asset at the time when it is bought into the business. Next comes dual aspect concept. Here, if one account is debited, one account must be credited. As we know, every business transaction has twofold effect. In other words, every transaction has to affect at least two accounts. Therefore, if one is being debited, one is credited automatically. Next comes the revenue recognition concept. According to this concept, the revenue must be recognized in the income statement of the enterprise. Recognizing the revenue means we are recording the income in the income statement prepared for a particular time period. Revenue means the amount that which is added to the capital as a result of business operations. Therefore, the revenue earned by the sales of goods of the business or by providing any kind of service must be recognized in the income statement of the enterprise. Next comes the matching concept. The expenses incurred in an accounting period shall be matched with the revenue recognized in that period, which means that first the revenue should be recognized and then the cost incurred for generating that revenue should be recognized. Next comes the accrual concept. According to this concept, the effects of one transaction and other events are recognized on mercantile basis. Here, mercantile basis means as and when they occur. That means they are recorded in the accounting records and reported in the financial statements of the period to which they relate. It cannot be recorded in a different period. Next comes the objectivity concept. According to this concept, the accounting transaction recorded must be free from personal bias and then be supported by adequate evidence, which means, in other words, that an accounting transaction should be recorded in the financial manner which is free from any person bias of either the management, the accountant, or any person who is preparing the accounts. Therefore, this principle requires that each transaction is recorded in the books of accounts according to adequate evidence which is there to back it or support it. Thank you. Hope you enjoyed my video. I will be back with more such mini concepts.